Hi, I'm Ross from Crimsmith Property Accountants, and we're looking today at why do you buy investment properties? Why would you look at buying one? And which is better, shares or property? The age-old debate. So I'm going to share my information and just go through some simple things to start with. So, yeah, obviously there is no guarantees in life. We don't know exactly what returns are going to happen. But if we start looking at a standard situation, say you've got a personal house worth 800,000, just to make it really easy, you've got no debt and you've got $100,000 to invest. So let's say you go into shares, bonds, something else, and you get 10%. I'm not a share investor, I'm not a fund investor, I'm a more property guy, so not my sort of thing. But 10% would be a pretty good return consistently for shares or funds. You're doing pretty well. So say you got 10%, you're doing, yeah, $10,000 return a year. Hey, let's get a little bit more exciting. Let's say you're getting 20%, that's obviously 20,000, or if you got 30%, that would be 30,000. So like if we just stick with that, we stick with our 30% return and say you're going to do amazing in funds, they're going to do amazing. So if we compare that with property, how would that compare with a normal property? And the big reason that we buy property, or the big advantage it has over shares or funds, is we're not going to use $100,000 of cash to buy a $100,000 property. We're going to use the $100,000 cash and yeah, the equity in the personal home to maybe buy $1 million property. So when we're looking at gains in property, we're looking at that on the $1 million. So property in the past, over the last 20 or more years, it's averaged about 6.3%. So we'll just bring across my little graph for that. So this is a graph of property since 1996. Yeah, you can see the market goes flat, booms, boomed like absolute crazy in COVID. And the green line is 6.3. So that's where it normally sits on, except for COVID. And yeah, who knows what's going to happen in the future, but normally sits around that 6.3%. So property, 6.3%. If you're buying a property for $1 million, you're obviously going up 63,000 in that. So that is your big advantage and big reason why we look at property is over time, property generally slowly goes up in value, and that's all based on the past. I don't have a crystal ball, none of us do in the future, but in the past, it's done extremely well with capital gain. Even at 6.3%, that's a $63,000 average gain. And you might not get that for the next few years, but if you're looking over a 20-year period, you generally sort of more look at those long-term averages. Short-term, very hard to predict. But yeah, 6.3 in property massively outperforms 30% in shares or funds because of leverage, because you're borrowing to buy $1 million property where you're very unlikely to go to the bank and borrow yeah, another 900,000 to buy some shares. Not many people are game enough or aggressive enough to take that risk. So that's your big reason. That's the big difference. So yeah, generally when you're starting out, you want property to gain some equity. So to me, there's a clear advantage in there early on in your cycle, building up equity. Property to me is the clear leader. And it's still a good idea to have your KiwiSaver and some other things ticking away. But to me, you can make a lot of equity, yeah, over a long-term period, 10 or 20 years, through buying a reasonable property and just holding. So really simple strategy. Long term, once you've got that equity, then it can change a little bit. Often, once you've got the equity, you're looking at more retirement, and property often doesn't give you the cash flow, whereas shares and funds, you can draw down little bits. So, yeah, as time changes, I think property is the clear winner at the start. Near the end, when you're wanting to get more and more cash flow, you're looking at retirement, you're wanting regular money in, shares and funds can generally win then and just be a lot easier to get regular money out. Whereas with a house, you can't sell that wall, and then you can't sell that wall, and you can't sell the laundry and then the kitchen. You've got to sell the whole thing. Whereas funds and shares, you can slowly draw down to suit your lifestyle. So hopefully you found that interesting and you've seen, yeah, why we invest in property and why you might look at doing that. Thanks a lot. Bye.